So infinite banking is, at its core, it's just taking back the banking function in your life. And everyone has banking functions. When you make money, you store it somewhere. Most people store it in the bank. Think about when you get paid, you have a direct deposit into your bank account. So you never even touch the money, it just goes directly to the bank. What does the bank do with that money? They don't keep it, they lend it out. So all they do is they just pay you a small percentage for holding onto your money, and then they go make a spread. So they lend it out, let's say at 10%, they pay you 1. They're making a 9% spread, which is a 900% return. They turn 1% into 10, and it's our money. So all we're doing with infinite banking is taking back that function, having the money flow to the policy first, and then using it just like banks use it. So if you flow your money to a policy, now you've got a warehouse of capital. Think about what banks do. They get money coming in from different people, a deposit. They have this warehouse of capital, then they lend it out and go make that spread, right? All you're doing with infinite banking is the same thing. You're flowing your money to a policy first. You got this big warehouse of capital now. You can lend it out to people. You can buy things instead of borrowing from the bank. I've bought 6 cars using this concept. And I get all the money back for all those cars because I'm the bank.
This is my time. Hi, I'm Kyle Stephenson, and you're listening to the Assets and Orthopedics Podcast. In this forum, we hope to educate medical students, residents, physicians, and other high-income professionals on the power of investing, especially in real estate assets and syndications. We want to help providers gain financial intelligence with the hope of earning financial freedom. Please listen and learn so you can spend more time doing what you love with who you love. Enjoy the podcast. Hello and welcome to the Assets and Orthopedics Podcast. This is your host, Kyle Stephenson. I'm excited to introduce you all to our next guest, Mr. Burr himself, Devin Burr. Welcome to the show, sir.
Thank you for having me, Kyle. Appreciate you.
Absolutely. So before I get started here, I'm sure you're in great shape. I've seen it on social media, so I'm sure you don't drink much alcohol. But I'm excited to discuss BYOB with you, which is actually Be Your Own Bank. So we're going to get deep into that. Stupid joke to start the podcast, but
yeah, I just drink a lot of this stuff. Water. It's weird. Our bodies are made up of like 70% water. You should probably drink a good amount of it. It's probably a good idea.
Yep, that's good. Speaking of physicians who, some are healthy, some are not. But the big thing is that BYOB stands for Be Your Own Bank, and you're a big advocate. So we're going to get into the infinite banking concept today. But I'm going to give a quick introduction to you, and then we'll go from there. So Devin, Mr. Burr is an expert in discussing specially designed cash value life insurance policies, aka the infinite banking concept. In 2016, at 31 years old, he was bankrupt down to $300 to his name. In 2020, he learned a concept that absolutely changed his life. He learned how money really worked and how to become the bank. By simply taking back the banking function in his life, paired with real estate investing, he became a millionaire by the end of 2020 and multimillionaire by the end of 2021. He started sharing his knowledge of policies and infinite banking on TikTok and social media in December of 2020, and he grew his brand and grew his name pretty quick. He quickly grew a following and now strives to teach more and more people about the power of becoming your own bank. So add to that, what else can you say on the introduction?
I mean, that pretty much sums it up. It was, 2020, I was doing real estate. I learned this concept of infinite banking, and I thought it was amazing. I saw the power of it because really at its core, you're just borrowing against an asset. Life insurance is an asset. So if you have cash value, that asset can be used for anything. Like if you're going to buy a house and then you just see that you've got 6 months of reserves, your cash value serves as that. You show them a cash value statement, they're satisfied. Any underwriter for any mortgage company. So it is a real asset. You're just borrowing against it. So because of that, that asset keeps compounding and growing tax-free. And if you take that borrowed money and you put it into real estate and you get a 20% cash on cash return, 30%, 40%, whatever it is, you're literally making money in two places: in the policy on a guaranteed basis, tax free, and then outside the policy with what you know, like, and understand. I know, like, and understand real estate, so I make money doing it because I know what not to do, right? So I'm not going to lose money. I've only lost money one time on a real estate deal. So I'm literally making money in two places. When I saw that in action, this was incredible. I had to get more policies. I had 4 by the end of that year. I'm telling everybody. And now I sit with 15 policies. I've got my wife insured, my daughter's insured, my parents, my in-laws. Because think about this. If you can do what I just said, borrow against an ever-growing asset, you're always going to be able to borrow more. So you're always going to be able to take it and make more money. But everyone is guaranteed to die at some point. So if I insure everyone in my life and use these policies to make more money and build wealth, they're going to eventually pass away. That death benefit is going to make the family wealthier because it's tax-free money. So when my dad and mom eventually pass away, a death benefit comes to my trust, tax-free. I take that tax-free money and fund more policies on my kids, grandkids if I have them, all tax-free. So if you really think about what's happening there, I'm earning compound interest tax-free. Someone passes away in my life, I get a tax-free death benefit. I put it into tax-free growth again, and eventually those people will die. My family just gets wealthier and wealthier and wealthier, tax-free over time, guaranteed.
Yep. So that's what the Rockefellers, the Disneys, the big families are doing, right?
Yep, 100%.
And I just had a conversation with a resident physician. We were talking about, he's like, I want my legacy, my wealth to go down all the way down to, my great grandkids. Most people, I think it's like, it might even be 90% of wealth doesn't go past the third generation, right? Of people just doing your regular investing, whether it's real estate or stocks or whatever. This seems like it's the way to go past that third generation.
Yeah, it just takes a little bit of planning. And once you plan it, you just have to do it. It's like anything. I could tell you how to ride a bike, but unless you get on the dang bike and try to ride it, you're never going to be able to do it, right? So it's like anything, man. If you take the necessary steps, it will work, and it's been proven to work because life insurance has been around since the 1700s. It's not a new thing. It's stood the test of time.
Yep. So, Devin, just to fill you in on this podcast, we speak to physicians, we talk about assets, we talk about entrepreneurship, we talk about, money, finances. And so we speak to medical students, residents, and any physician really. And so I had Brent Kessler on, a few weeks ago, and he mentioned your name, which is cool. But yeah, you guys talk about this infinite banking concept that you were just getting into, described by R. Nelson Nash. He has a couple of good books on it that I've read recently. What's the easiest way? So before I ask that question, I had plenty of feedback from that podcast episode and a lot of positive feedback. I was actually surprised how much positive feedback I got on it. But I did get a couple of people that reached out like, hey, man, it's a scam. Be careful of that one. Maybe you should take that one down, whatever. And I was like, no. So that's why I was glad to have you on to help reiterate things. But what's the easiest, most simple way you can explain this to somebody that just has no idea of the concept?
So infinite banking is, at its core, it's just taking back the banking function in your life. And everyone has banking functions. When you make money, you store it somewhere. Most people store it in the bank. Think about when you get paid, you have a direct deposit into your bank account. So you never even touch the money. It just goes directly to the bank. What does the bank do with that money? They don't keep it. They lend it out. So all they do is they just pay you a small percentage for holding onto your money, and then they go make a spread. So they lend it out, let's say at 10%, they pay you 1%. They're making a 9% spread, which is a 900% return. They turn 1% into 10, and it's our money. So all we're doing with infinite banking is taking back that function, having the money flow to the policy first, and then using it just like banks use it. So if you flow your money to a policy, now you've got a warehouse of capital. Think about what banks do. They get money coming in from different people, a deposit. They have this warehouse of capital. Then they lend it out and go make that spread, right? All you're doing with infinite banking is the same thing. You're flowing your money to a policy first. You got this big warehouse of capital now. You can lend it out to people. You can buy things instead of borrowing from the bank. I've bought 6 cars using this concept. And I get all the money back for all those cars because I'm the bank.
From what I've seen, you're not buying Honda Accords.
No, no, I've got a Porsche 911. I've bought an R8, a Porsche Cayenne. I did get my wife a Toyota Camry because she could care less about cars. So it is what it is, though.
Very good. Yeah. So on that note, I want to talk about BOLI here in a second, but I sent the last episode, Brent Kessler episode, to my lender, the guy I use all the time. He's a family friend. And I said, dude, check out this episode and let me know your thoughts. And he called me after he listened to it. He's like, hey, I looked them up, the Money Multiplier. They have somebody in Indianapolis. We should meet with them. I'm very interested.
Who is it on the team they're meeting with?
He hasn't decided anybody yet. He just said that he thought there was somebody from Indianapolis. He wanted to sit down and pick their brain. So I'll send him your way. How about that?
I like that. I don't know if we have someone in Indianapolis, but
yeah, you may not. I know your biggest customer's in Indianapolis.
Yeah, we write policies through a company, One America, and they're out of Indy. So
maybe that's what he was going for.
Yeah, that's like probably our biggest company that we use because they're really, really good client service and they've got a high guarantee on the growth. They've got a track record of paying dividends. They've been in business for 148 years. So just a stable company to use.
Yeah. On that note, can you talk about the BOLI, the bank-owned life insurance?
Yeah. So BOLI is it's bank-owned life insurance, obviously. What it is banks know that this is a stable asset because, again, it's contractually guaranteed to go up every single year, tax-free. So what banks do is they take a large amount of their tier 1 capital and they fund these kind of policies and then use them to lend on cars, use it to lend on houses and what have you. What they do, though, is they insure somebody at the bank. So if you go into a bank, that's why you always see vice president of XYZ. Everyone's a vice president. And it's because if they're a vice president, they're a key employee to the business. So now the insurance company will insure that body with the bank being the owner. And here's the crazy part, man, is I've talked to some of these bankers before, these VPs, and I'm like, hey, just out of curiosity, when you got promoted to VP, did you get a life insurance policy? They're like, yeah, I did. I didn't have to pay a penny. I'm like, oh, so it's a paid up life insurance. They're like, yeah. Like, how much is it for? 50 grand if I pass away? Which is crazy to me. How much is that policy really for? $1 million, 2 million, 3 million? So if that person passes away, 50 grand goes to their family, the other amount goes to the bank. So, but who wouldn't want a fully paid up life insurance policy? It's just a free perk. So that's what they give their employees is this paid up life insurance. They don't have to do anything for it. But now the bank is using that as a vehicle to become more wealthy and then just lends out of it instead of just lending directly.
Yep. Genius. So, why not do what the rich are doing or the banks are doing?
Banks own billions and billions and billions of life insurance. Banks are pretty good at making money. There's a saying, go make some bank. Why do you call it that? Because banks make a lot of money. There's not a bank in the nation that makes less than 400 to 1,300% on our money.
Wow.
They know what they're doing. So they're not stupid. They just know something that most people don't. And the reason why most people don't know this is because the agent is actually incentivized to make the policy less beneficial for infinite banking. Like the more the policy is built for infinite banking, the lower the commissions. So the agent has to know how to do it And if they know how, they have to be willing to do it. So a lot of people, they don't get policies like this. They get policies where they put $1 in and they can't use anything for years. That's because the agent made a ton of commission. What we do is we lower our commissions so that our clients have all this cash value. They can go use it to be their own bank. We're making less commission, but we do a lot of policies. We've done over 15,000 policies around the country.
Nice. Yeah. So that means it has to be something that actually works so that more people want to do it. You're all about getting more volume.
More volume, word of mouth. We take care of people. They're going to refer their friends, family, neighbors. So that's what it's all about.
That's great. So yeah, I mean, as a physician, I started this podcast about a year and a half ago now, and I've been diving deep into real estate investing for the past 4 or 5 years. And I know that physicians, generally speaking, physicians, we learn nothing about finances, right? Medical school, you learn how to be a physician, but you learn nothing about how to use that money when you're going to be out making money. And so a ton of physicians, do the traditional investing. They don't invest in real estate necessarily until maybe later on. They will just, have a financial advisor, trust he or she, and put their money in a 401k, a Roth IRA, like the standard stuff, right?
Hope and pray,
man. And so I looked up in, the 401k. I've listened to your podcast. I've listened to, hundreds of podcasts about this, but the 401k started in 1981. So it's still fairly new. And now is when people are really starting to see the negatives of the 401k, right? It was always this, hope and pray to your point. And my father-in-law is a retired orthopedic surgeon. He's about 3 or 4 years out now. And he's seeing the negatives, the drawbacks of the 401k. So we've been talking a lot about it. But I want you to explain why the 401k sucks, basically, and why the infinite banking concept is a better approach.
Well, anything that's government, any kind of government plan, which is a 401k, IRA, all those things, they're always put out to fix a problem that the government made. The problem when a 401k came out is like taxes were really high. So they're like, oh, we'll give you a way to defer the taxes. So they created the problem with the taxes. Now they're giving you a solution. Doesn't seem right. But here's what I don't like about them is 401ks, you're deferring your taxes for a later day when you have no idea what the taxes are going to be. You know what taxes are right now. So pay the taxes now, never pay them again. Don't defer them and wait till they're probably higher. That I don't like. Another thing I don't like is that the money's being made in the market. So when you retire and you pay taxes, you should be paying capital gains because it's in the market. It's not like that. It's earned income. So you're actually paying at a higher tax bracket. Capital gains is 20% long term. Highest tax bracket for earned income is 40%. So that right there doesn't make sense. 2, there's limits on how much you can do. So you can only do, I think, 19 grand a year. And then you can't use it without penalty until you're 59 and a half. So you're giving up control of your money now when it is worth the most because of inflation to have access to it later when it's going to be worth less, guaranteed. You're not paying taxes now when you know what it is to pay them later when they're probably going to be higher. You're not paying taxes now to pay it at a higher rate because it's earned income instead of capital gains. You're limited on how much you put in, so you can't get this huge amount of money when you retire. And then there's actually a time where you have to start pulling from it because the federal government wants you to eventually pay taxes. So if you don't pull from it, I think it's 71, you actually have to start pulling from your 401k so you pay taxes. I think it's a scam. The average person, average 401k at retirement is about $350,000. And the average person in America right now makes, I believe, 60. So if you make 60, you're used to making 60 before tax, you got 350 grand at retirement before tax. That's not lasting for your entire retirement, not even close. It's a flawed system, a flawed thing that just now, to your point, people are starting to realize. Because if you got one in 81, let's say you were 21 years old, you were born in 1960. How old are you now?
60, 65. Yeah, there you go.
65, 64. So now you're starting to retire. Now the proof is actually in the pudding. Like, oh, these aren't as good as we thought they were back in the 80s.
Nope, it's wild. And yeah, so right now you're taxed on the seed, but if you put it into a 401k, you'll be taxed on the harvest. Much greater number at that point. Yep.
People always say this. They'll be like, oh, but you'll be in a lower tax bracket, which boggles my mind. When I retire, I don't want to like have a lower lifestyle. I want to have a better lifestyle. I want to be taking trips. I want to be doing this. I want to be doing that. So if you go off of that whole notion of, oh yeah, you'll be in a lower tax bracket, you're basically saying, okay, I'm going to be broke when I'm retired.
Exactly.
It makes no sense.
Yep, you're exactly right. And my father-in-law, for instance, he even said with all of his investments, he's making a ton of dividends now. So his income is actually, I mean, I'm not going to give a number, but it's insane how good his income is now. And he's not working for that income. You're making income in other ways. I mean, he's still making a great amount of money. So yeah, for those that think that your income is going to be zero when you're that age, well, you're going to be broke. And then none of this will really matter.
Right. Then you're going to have to be working at Walmart as a greeter.
Yeah, you're preventing yourself from being homeless at that point. So we're going to speak to, physicians, because obviously they do well enough to make money and put money in the 401k and do all these other things. So let's just do an example of the infinite banking concept. Say, so they can still do their investments, of course, right? Let's do an example of somebody buying a car with the infinite banking concept. Can you give me like a quick example on that so that somebody understands how it actually works, like illustrated?
Yeah. So I'll take an example of a car I just purchased. It was kind of a nostalgic purchase for me because I was born in 1985. So when this car came out, I was 15. So I wanted this car really bad at 15. I couldn't afford it. And then by the time I could afford it, I had a baby at 22 and it's a two-seater. I couldn't get it. So now, like my daughter, she's 17. I'm in a place where I make plenty of income. I can buy the car now. So it's a Honda S2000. So I just bought one of these, one owner, 27,000 miles off of Bring a Trailer for 31,000 bucks. Okay. So how do you normally buy a car? You pay cash, you finance, or you lease. That's how you buy cars. What I did is that I took the money from my policy, 31,000 bucks. That's cash from the policy, bought the car. Okay. Now, if I would have borrowed that 31 grand from a bank, I'd have to pay them back with interest, right? So all I did is I figured out what the bank would have charged me. It was a 5-year loan at 7% interest. The payment's like 685 bucks a month. So all I did is just take that 685 a month that I would have otherwise paid the bank, and I just pay it to my policy. So the way it shakes out, guys, is the numbers over 5 years, I pay back $41,000 into my policy. Okay, so I pay $41,000 into it. I also put premium in for 5 years. It's $50,000 a year. So altogether, premium in plus repaying myself, I put in a gross amount of $291,000, right? Premium plus repaying myself. I also used the 31 grand. So my net injection is, what would that be?
260.
Yeah, 260. That's my net injection, right? During that same time frame, my cash value grows by 386.
Damn.
I make money technically buying the car over that time frame, and I own the car. So if I sell it, I'm going to keep the miles real low. It'll probably keep going up in value. Let's say it's worth 40 in 5 years. I sell it, that's another $40,000, and I got to own the car for that 5 years. You see what I'm saying? So it's very simple. It's just you're using money from a policy, you're having it do something. In this situation, it was buying the car. And then you're simply turning around and flowing the money back, just like you would flow the money back if you bought that car from a bank. You bought it from a bank, you have to pay that bank back every single month without fail. So all I'm doing is just I'm paying my policy back, which is where I borrowed the money from. So I'm getting all the money back plus the 7% interest, and my money just keeps compounding and growing. So that's how I can make money by buying a car.
Yep, that's really cool. So that's the cool part. You pull money out of the cash value, but that cash value continues to grow, compound interest, unaffected, right? And the death benefit will continue to grow, unaffected, compound interest.
Right.
And then the other thing is when you're paying it back, you're paying it with the interest. When you borrow, you do have to pay a 5% simple interest, correct? So when you're paying it back, you're basically paying down that interest on top of it. Right. Okay. Yep.
That's where people get confused. Sometimes they're like, well, why would I pay interest to use my own money? I get that a lot. People will say, well, that's stupid. Why don't I just use my own money? I don't got to pay interest if I use it from the bank. But what people don't understand is they're not using their money. When they put money into a policy, that money does not get removed. That's how it keeps growing and compounding. They're borrowing against it. So they're actually borrowing the insurance company's money. The insurance company is going to charge an interest rate to do that. So you're borrowing the insurance company's money. Your money just keeps compounding and growing. And then if you pay it back, if you're an honest banker, you're lowering the balance. So the simple interest every month, you're paying less and less interest. So if you do it correctly, your effective interest rate is actually much lower than 5.
Yep, exactly. I'm going to stick on this for a couple points, all right? And I'm going to say these points, and you can correct me if I'm wrong, or I'll even ask you, because again, I've listened to enough stuff to where I feel like I have this fact correct. But most people, I don't even know who these people are, who are telling physicians or telling people in general that, invest in the stock market and buy term life insurance. Never touch whole life. Always buy term life insurance. All right. Devin, answer this question if you don't mind. What percentage of term life insurance gets paid out?
Less than 2%.
Which is insane. So is it true that the people that are paying the term life insurance are essentially putting money in that general fund that you can borrow out of? I mean, is that a stretch?
That's 100% accurate. So, I mean, think about it as a business owner, you're going to push something that is profitable. If term insurance is only paid out, I think it's like 1.4% of the time, something like that. It's less than 2%. If it's only paid out about 2% of the time, that means that the other 98% of the time, that's just profit. So why would you not push that? So that's why everyone says buy term, invest the difference, buy term, invest the difference. Because one, it's very profitable. So the commissions are actually very high. And because it's profitable, it actually helps when you own policies like myself that are mutually owned companies. When you own whole life, the profitability of the insurance company is shared with all the policyholders. So all these people that buy term and invest the difference, I'm like, keep doing it because you're just helping me get a bigger dividend because it's profit 98% of the time.
Yep. That's cool. I mean, another point that I was going to make that helps the cause for infinite banking concept is how much we pay in interest. So Tony Robbins has the book Money Master the Game. He actually talks about this concept in there in chapter 5, but he also talks about how the average person pays about 54% in taxes overall. And then of what's left, you pay about 34 to 35% in interest alone. So then on that note, when you buy a mortgage, a 30-year loan, 80% of your interest that you're going to pay in total, 80% of it, you're paying in the first 7 years. Is that right?
Yep. I think it's even higher, 80 something percent. So this is the thing is if you're really smart about money, you don't have to go take big risks. You don't have to like, so many people want to know what's the next best thing? What can I put my money in and double it within so much time? The more the more upside an investment has, the more inherent risk it has. So like if you try to go make more money, most likely you're taking on a lot more risk, so you could lose everything, right? With infinite banking, all you're doing is you're plugging holes in your financial life. To your point, 54 cents out of every dollar is taxes. With policies, tax free. So you pay taxes now, never pay them again. And if you're losing money to interest, if you plug those holes, like for me, with the cars I buy, I'm no longer losing that money to the banks. I'm getting it back. So I'm literally becoming wealthier by just not giving my money to everybody. If I keep 90 cents out of every dollar and everyone else is only keeping 10 cents, if we make the same amount of money, I'm going to be way farther ahead with compound interest. So it's just plugging holes in your financial bucket. The more you can plug those holes, it starts overflowing, and then you just start getting more policies. That's why I've got 15 of them. I think Brent's got like 26, something crazy.
Yeah, that's awesome. Well, I'm about to have my first one, so I'll let you know how it goes. But that point, what you just talked about, Robert Kiyosaki has always said, and I used to, be obsessed with him, but I didn't understand all his concepts. I just was like, man, someday it's going to make sense. And I think that day has hit me more recently, where he says, it's not about how much money you make, it's about how much money you keep. And I used to think it was just the taxes. I'm like, okay, how do we minimize our taxes so we can keep more money? It's not just that. It's the taxes and giving it up to the interest, to the banks, to everybody else, right? So,
because think about this, and he's exactly correct. If I have $100, okay, I take this $100 and I give it to you. This $100 will never make me money ever again. It's gone. It's lost its opportunity cost. So if I take my money first and put it into a policy, it never stops growing for the rest of my life, guaranteed. So if I do that and then I borrow against it and then I give it to you, at least I haven't lost its opportunity cost, right? So that's the whole thing about keeping more of the money. If it first goes into a policy, it'll never stop growing. And then if you use it on an investment that goes sideways and you lose money on that investment, it's still compounding and growing in the policy. You're not losing its ability to grow. So I tell people all the time, it's like, buy whatever you want. Don't change anything about your life. Just change where your money goes first. Put it here first and then pay your bills. Put it here first and then buy cars. Put it here first and then do investments. Put it here first and then go on vacations. So I don't know, man. It's been a godsend for me, and I just wish I would have learned it before I was 35.
Yeah, I mean, cool for you, man. We're the same age, and you figured this out long before I did. So I appreciate you. Yeah, I think Brent Kessler, his daughter Hannah, Chris Noggle, and yourself, you guys do a great job putting this out there and making it simple for people to understand.
It's a different concept. It's not hard. It's just different. So
exactly.
So it's kind of hard to grasp sometimes, but if you just take a look at it from what it is, like I said at the beginning, it's just an asset that you're borrowing against. If you have a house, you can borrow against the house, right? If you have equity, and that equity is a loan from the bank. The house is the collateral, right? It's the same thing. With policies, that's your collateral. The money you're putting in is the collateral. So it's growing. A house can go up in value, right? A house can also go down in value. Policies can only do one thing, and that's go up. So it's always going up, and you're just borrowing against it. You're borrowing the insurance company's money, using your money as the collateral. Same thing as a house. Your house is the collateral to use the bank's money. All you're doing is just using your money as collateral and borrowing the insurance company's money.
Yep. It's genius. So a couple more points and then we'll start to wrap up here. But you mentioned this earlier, and so I just want to bring this up. My dad just passed away recently in the last month, honestly. And And you talked about this on the Chris Noggle podcast about getting a policy for your dad, I think, when he retired. And so I was thinking about this. My dad passed away. My mother, they were married for 49 years. And, she has what, he left her, which is great. But I was thinking for somebody like my mom, say she didn't have enough money, could I buy a policy for her, put me or my trust as the beneficiary, and then she can use the cash value to live the rest of her life. And then when she passed, my trust would get the death benefit.
Yep. 100%. So just so people will understand how this works, and I touched on it just a second ago, you're borrowing from the insurance company, your money's the collateral. What you're essentially doing is you're borrowing your future death benefit while you're alive. So like, let's say I borrow $1 million from my policy and my death benefit's 10 million. If I pass away the next day, my family does not get 10 million, they get 9 because I've used $1 million. So essentially what you could do is you could get the policy for your mom. She's the insured person. So her body is insured. You or your trust is the owner. So you have control of everything. She's just the insured body. So she has a death benefit. And same thing, the money you're putting in is collateral to get a loan from the insurance company. So basically her death benefit. So what I do with my dad is I pay him a retirement income, which is the cash value. I just give him the money. It's tax-free because loans aren't taxed. He never has to pay me back. So what's going to happen is I'm going to keep having a higher loan balance, but it'll never outweigh the death benefit. So when he passes away, easy math, let's say it's 500 grand. Let's say I've paid him 250. My trust is going to get the surplus. So I'll just get 250 and I helped him retire, gave him tax-free income, and my trust gets wealthier over time when he passes away.
That's amazing.
You could do the same thing as long as your mom's approved.
Sure. Health-wise and all that stuff, right? Yep.
She can't be robbing banks and killing people. She's not getting approved.
Nope. Irrevocable trust?
I'm not an expert at that, so yeah, talk to lawyers on that.
Yep. Nope. No problem. I want to get into real estate investing really quick because I think that's a really cool avenue. And once Brent Kessler brought that up, how much he invests in real estate, I love that because you can basically be a private lender with your cash value. And so say Chris Rude or say you have a flip and you can flip this in 3 to 4 months and you need $100,000. I can take my cash value, hand you $100,000 for the flip. And then I can say, yeah, I want, 15% return. I would be the bank essentially, right? And then in 3 to 4 months, you'd pay me back with the 15% as a private lender.
Right. While your money is still compounded in the policy, tax-free.
I freaking love that.
Yep. So I made a video about this on YouTube a couple weeks ago, and it's that exact same thing, using policies to be a private lender. So it actually makes it to where you make a ridiculous amount of a return. You just have to look at it on what it really is. Like if it makes, let's say, 5% in a policy, which it's about 5 to 6 with dividends. So let's just say 5. If it makes 5, and then I use the money and I lend it at 15. What am I making together?
20,
right? Now, remember, you're borrowing the insurance company's money. They charge an interest rate for that. Generally, it's about 5%. So I take 5% borrowed money to do this whole thing. So it took me 5% to make 20. What's my net return?
15.
But that's not accurate. Remember, I'm not using my money. I'm turning 5% into 15 net. That's a 300% cash on cash return by simply changing where it goes first. If I take the money first and I lend it to somebody on a real estate deal at 15%, it's making me 15%. That's it. If I take it, put it in my policy, borrow against it, and then lend it, it's making me 300%.
Yeah. Wow.
It's crazy.
Wow. Mind blowing. No, that's awesome, man. Yeah, and it's cool. Like on your podcast, you've had some of the big name guys in real estate on that talk about the same things.
Yep.
It's really cool. And so these are things that physicians just don't get. Like, all in all, I'm not generalizing. I'm not saying every physician, but for the most part, we think like the middle class, unfortunately. Whereas we should be thinking more like the ultra wealthy, or at least the wealthy. And this is the way the wealthy think.
Yeah, because there's a difference between wealthy and rich. Most physicians are technically rich if you look at how much they make. So I forget the exact number, but I want to say anything above, I think it's 250 a year, is in the top 1% of all earners. So technically you're rich at that point. You're definitely not wealthy, right? Think about pro athletes. They're rich, filthy rich, but they're not technically wealthy unless they start buying assets that work for them. Most of them just buy bling bling and bottle service. So there is a difference, man.
And not even just the bling bling and bottle service. Like professional athletes are, for the most part, I think have the same mentality as physicians, just on a bigger scale, because they still pay a ton of money in taxes. So that's at least 50%, more than likely, more like 60 probably. And then they pay their agent 3 to 4%. They're paying their CPA this. They're paying this guy this. I mean, that all adds up. How much do they actually bring home? It's minimal.
Dude, that's why you always see these pro athletes going bankrupt. Because let's say, I think football, the average career length is like 3 years. Crazy. So if you're making multi millions for 3 years, if you're not smart with it, it's not going to last. It's not going to be stretched. So with a physician, yeah, like I've got some clients that are physicians, then they're my favorite clients because they make a good amount of money, so they can put a lot into policies. Like policies are great if you have money in there. If you're putting in $200 a month, there's not much in there. You can't do much with it. But if you're putting in 20 grand a year, 30 grand, 50, 100 grand, you can do a lot with that money because there's a lot in there. Does that make sense?
Yep, it definitely does.
So I love like my physicians. I've got one physician that does 220 grand a year into his policy, and he just immediately takes that money and starts lending it out. So now he's like building this just compound machine and extra cash flow for him with his practice. So you just have to know what you're doing. You have to have a little bit of wherewithal. And once you know what to do, you just got to do it.
Yep, exactly. 2 quick points, more philosophic on this concept. Tony Robbins talks about it, as I mentioned in chapter 5 of his book, Money Master the Game. And he asked the question, why do we invest? And, people are like, oh, returns and this, that, and the other. The actual answer is income. We invest for future income. That's all it is. And so with this cash value and this, specially designed life insurance policy, we're getting that income throughout life. That's the cool part. And it's only growing.
Yeah. I'll give you guys an example of one of my policies right now. So it's actual numbers in retirement years. So if we look at this policy here, I did when I was 35. So it's had a little bit of time to mature. I'm about to be 40. But let's go when I am, let's say 60, 70. What do we want to use?
Yep. Go 60. Retirement age.
At 60 years of age, the policy's cash value grows from $5,915,000 basically to $6,108,000. So what's that? About 100 grand, right? Give or take. The premium at that time is only 50,000. So it grows by more than the premium. What I can do at that point is just take the growth, let's call it 100 grand, take 50 of it, put it into the next year's premium. The difference is my tax-free income. And because I put more money in the compound growth, the next year it grows even more. It grows from the 6.1 to 6.306. What's that? That's
200,000.
Yeah, I apologize, guys. It was almost 200 grand that last year. This one is 199,000 the next year. So now, again, 199,000 grows by. I take 50 of it, put it in for the next year. Now I've got 144,000 of tax-free income. My income literally goes up every single year, guaranteed. And this is just one policy. I've mapped it out. I forget what it was. I think it's at like year when I'm 70. With all my policies, I've got like $1 million in income. I don't got to do anything for it.
Goodness. So if one of my listeners calls you and says, hey, I want to get a policy going, and do you guys help them along the way? Say 5 years from now, they're like, hey, what do I do with this policy? I want to get another one. Do you guys help them along the way?
Yeah, so every single client gets a service that not everyone takes advantage of, which I have no understanding why they wouldn't take advantage of this, but it's a free service. Every single person gets basically an implementation specialist, someone on the team that helps them implement their policy. Some people don't even set up their first call with those people, which boggles my mind. But we give that to you for free, and they follow up once a quarter to see how they can help. That's a free service. So, yeah, our team helps. We look at like the infinite banking concept as like think of if you're a golfer. I golf, so this will make sense if someone golfs. If you golf and you go buy the best clubs there are, they're fitted to you, everything is perfect, they're the top ones on the market, but you have no idea how to swing them, you'd be better off buying some crappy clubs and getting your swing corrected first than buying the best clubs and not knowing how to swing them. Infinite banking is the best clubs possible, but if you don't know how to swing them, they're just going to sit in your garage and collect dust. We teach you how to swing the club, so that way you can get the most out of it.
Oh, that's amazing. All right, one more philosophical point with this infinite banking. So there's an awesome book called Die with Zero, Bill Perkins. Fantastic if listeners haven't read it yet. But again, my pops, passed away a month ago, and so we had deep conversations about dying with zero and spending that money on the people you love while you're alive, not just giving them a massive inheritance when you die, right? And I think he did both. But the point of that is the whole die with zero in your bank account. I think with infinite banking, you can almost get both, right? You can have your cake and eat it too, right? So you can spend money on those you love while you're alive, but then when you pass, they get the death benefit. So they still do get that inheritance.
Yeah, and that's a slippery slope. So I wouldn't just give someone a death benefit. So for instance, I think I have at this point about $50 million of death benefit on my life. So if I passed away tomorrow, let's say, and my wife passed away, our daughters would get $50 million if that's how it's set up. That is not good. My oldest daughter's 17, my youngest is 1 year old. So the likelihood that my daughter that's 17 would know how to keep and grow that 50 million, it's very unlikely. She'd probably just buy a bunch of dumb stuff. However, I have that money instead going to my trust. And my trust has a succession plan, which I created. So that way, when I pass away, the trust can only be used in that succession plan. So the 50 million goes to the trust. Now the trust dictates it has to buy more policies, and my daughter can use the cash value anytime she wants. It's going to be a lot of cash value. She can use it anytime she wants, but she has to pay it back. And why wouldn't she pay it back if the second she pays it back, she can use it again? So then what's going to happen is she's going to keep putting back into it. So the cash value is going to keep growing. She's going to eventually pass away. Her kids are going to get all that money into the trust. It's going to get bigger and bigger and bigger. This is exactly what the Rockefeller family does.
Yep.
They buy a policy for every single kid that's born into that family. We bought a policy on our youngest daughter when she was 2 weeks old. That policy is incredible. I'll pull that one up.
Yeah, do it.
This one is insane. It's $10,000 a year. That's how much I can put into the policy. And by the time she is my age, so I'm 40. So 40 years from now, when she puts in $1, it cranks out 15.
Wow.
Crazy. And that's only at 40. So like when she's like 60, 70, puts $1 in, it cranks out like 50.
Oh, that's amazing. Holy cow.
Just nuts. So it's all about time, starting them young.
Yep. Nope, that's massive. I love that. I got 3 young kids, 4, 2, and 6 months, and we need to get on it. We're about to sign our our first policy here this week. So
The younger, the better, man, because compound interest just takes time. So the longer you give it, the bigger it gets. And if you teach, kids are sponges, man. You know this. Kids are sponges. So they learn so much faster than us adults do because we have to kind of unlearn things that we've been taught in the past about money.
10 times harder to unlearn what you've already been taught, right? Yep.
So like a kid, you can teach them this stuff while they're growing up and they're going to grasp it like that. So when the kid is old enough and you are confident, like they can do this, they can do infinite banking, they can be their own bank, they can figure it out. They've seen me do it. I've showed them, blah, blah. You can assign the policy to them. So now they own their own banking system. Like my daughter, Haley, my 17-year-old, she'll never have to borrow from a bank. She's got 3 policies in her name. Her first car we bought from her policy when she goes to college, and she's paying herself back. So she has a job. She's paying $200 a month back into her policy for that car. And I just pulled the numbers up on it today, actually. She has in her policy that she's built back up $3,257. So she can use that money for whatever she wants, but then she just has to pay herself back like she would the bank.
Yep. That's awesome because it teaches discipline as well.
Yep.
Fantastic, man. It's good parenting. Good job.
I wish my parents knew this stuff and taught me. So my parents are both broke. I grew up from a very lower middle class family. Like my dad, most he ever made was 80 grand a year before taxes. And he retired last year. His 401k had 330 grand. And he's like, son, how am I going to make this work? Help me. So now I got him a policy, obviously, like I said. I took his 330 and put it into a self-directed IRA. Now we're investing in different things that I know and understand to help him grow. So I wish someone taught me this stuff, man, when I was a kid.
Yeah, it's amazing. It's amazing. You're doing a hell of a job getting yourself out there and educating people and making things simple and fun. So we appreciate that. Couple more things. Brand. You've built a hell of a brand. Mr. Burr, you're doing a fantastic job. Quick advice on building a brand.
I think authenticity.
Nice.
If you're just authentic to who you are, no one can be you better than you, right? If I go try to be Grant Cardone, I'm going to fall flat on my face because I'm not Grant Cardone. I'm not him. I'm going to be a knockoff version at best. So if you just lean into who you are and the value you have, that's the problem most people have is they don't become more valuable. So if you want to build a brand, you have to become first more valuable and then give that value away. That's all I did when I built my brand is I learned this infinite banking concept. I had nothing to gain from it. I became valuable because I understood it and I was doing it at a high level. So I just started telling everybody. So then my brand took off because I was authentically just trying to share what I had learned with no financial gain. So I think it's being authentic and becoming more valuable so that you have something to offer.
Love that. So I talked to Brent about this, but my plan is later this year in Indianapolis to have a conference for physicians to speak more about thinking outside the box, alternative funds, or not alternative funds, alternative investments, real estate investing. This concept, Brent said, he's like, oh, dude, I'll sponsor that in a heartbeat.
Yeah.
If I get it set up, would you come speak potentially?
In Indy?
It's in Indy.
Sign me up. Because then I can visit all my folks at One America. That's that company we run with. I love those people over there.
Brent will take his private jet. He'll pick you up in Arizona, and then you guys can fly private back to Indy.
That'll be a tough trip for him. He's coming from Florida, so he has to come get me. And
yeah.
he probably won't do that. I'll just jump on Delta.
There we go. Awesome, man. All right. Hey, final 4 questions, quick ones. What book are you reading right now?
I'm almost through it. It's Extreme Ownership by Jocko. I forget his last name, but great book. Great book. It just talks about leadership and owning every part of the process. If something happens that isn't what you wanted, you have to take a look in the mirror and like you owned it. It was your fault, kind of thing. So that's a great book. I'm on like the last chapter. So,
oh, that's great. What advice would you give your 25-year-old self?
Man, there's a lot of them. I think a big one though is stop chasing tail. Like there's so much power behind having the right woman behind you. I met my wife when I was 31, and like that woman makes me a better man, and she believes in me, she supports me. So you look at just anyone that's uber successful, any man that's uber successful, most likely he's got a really good woman by his side.
That's amazing. I love that advice. I literally just put this quote in my phone like 2 days ago. The real power of a man is in the size of the smile of the woman next to him.
I like that.
What is your definition of wealth?
I think the definition of wealth is just having abundance in all areas. Like you can have a ton of money, but if you're sick and you're constantly in the hospital and things like that, that's not wealth. But if you're super super healthy and you're living paycheck to paycheck, that's not wealth either. Or if you're really really healthy and you got a ton of money but no one likes you, that's not wealth because you've got no relationships. So I think it's having a balance of all those things, because so many times people just want to be so singularly focused on the almighty dollar that everything else goes by the wayside. That's why I'm so big on drinking a lot of water, going to the gym. I literally go to the gym 7 days a week. If I'm not actually working out, I'm at least stretching. I'm in the sauna. You know what I mean? I'm constantly working on my health. I'm constantly working on my relationship with my wife and my friends. My wife and I are taking a date night this week. My friends, I'm constantly contacting them and seeing how they're doing. I have a friend that has a baby on the way, and the baby has a heart condition already. They had to move out of state to go to the best doctors in California to help with that. This morning, I texted him, hey, bro, hope you made it out to Cali okay. He drove there this weekend. Hope you made it out to Cali okay and you're getting settled in. That's friendship. That's keeping relationships strong, right? I'm constantly working on my money. I'm constantly trying to become more wealthy in that aspect. So I think it's just having everything dialed in, not to mention your relationship with God, So if all those things are there, you're wealthy. But if one is out of alignment, it's just a matter of time before everything else kind of crashes.
Dude, I love it, man. Very well said. That's awesome. All right. Speaking of God, Proverbs 11:25 states, a generous person will prosper. Whoever refreshes others will be refreshed. If you could make a big impact by giving back, what would you or have you focused on?
What's funny is I wasn't wealthy until I started teaching this concept, right? Like I'd made money in the past. I was rich. I'd made over 250 grand a year before, but I was broke. I was paycheck to paycheck because I had 2 nice cars and everything was being lost to the banks, right? So when I started focusing on helping people and just giving my value, my net worth, my income skyrocketed. So the biggest impact I feel like I can give over time is changing the educational system. That's kind of my big term, long vision, is make it to where I can change what's taught in schools. And if it doesn't happen in my lifetime, hopefully my kids, carry that on. But I think to do that, I have to be sitting at some big tables. I got to be a billionaire. So I'm young though, man. I still got a lot of time ahead of me. So
yeah, you do. Yeah, I feel like you've done a lot in your short time. And honestly, I don't think it's gonna be hard for you to rub elbows with the Robert Kiyosaki's and even the Jordan Petersons or guys like that are making that impact in the education system that you could get involved with.
Yeah. Kiyosaki's out here in Scottsdale.
That's right. There you go, man. Your neighbor. I'm sure you see him at the gym, right?
He's off his rocker though, man. He's kind of crazy now.
Is he?
Oh yeah. He's got a few screws loose at this point. But the dude definitely knows his stuff when it comes to finances though.
Sure. Well, hey, we appreciate you, man. Thanks for coming on the show. I know you're a busy guy. You got more important things to do, but I know that our audience, our listeners will love this episode. So where can people find you?
The biggest place is Instagram. So it's Mr_Burr, B with 4 R's.
All right. And we'll fly you out to Indianapolis next fall for this conference.
Love it. Sounds good.
I'll be in touch. Hey, thanks a lot, man. Thanks for coming on. We'll talk soon.
Thanks for having me.
All right.
This is my time. I'm on the rise. Can't hold me down.
Thank you for listening. If you found value in today's podcast, please leave a review so our community can continue to grow. If you would like to stay connected or receive a copy of your free investing ebook, please go to www.sharpinvestmentsllc.com, and that's sharp with a P as in professional. This is not financial or tax advice. Please consult with your financial advisor or CPA.